Hey everyone, welcome to part 2 of this video on Indian alcohol beverage sector. In the first part of this video, we discuss the sector breakup across product category, distribution structure, key growth driver and challenges for the industry. Then we covered the top listed players across the segment. If you haven't watched that video, I would recommend you to pause this video and watch that first part. So in the last video, we identified top listed players across category of alcohol beverage industry that included United Spirit, Radico Khaitan, Elite Blender, Tilaknagar Industry in spirit segment. Then within beer, you have United Breweries and Som Distillery, and then Sula Wine in wine category. These are pure play alcohol beverage companies. And then we identify business that have alcohol beverage as one of their business segment. It included Global Spirit, Piccadilly Agro, Associated Alcohol and Triveni Engineering. The most interesting part is each of these companies command a different valuation. Some are at very high PE ratio while some have low PE. The question is, why is there such a stark difference in valuation? And does it mean high PE companies are expensive and low PE companies are cheap? That's the topic of today's discussion. It would help you understand why some companies command a premium valuation as compared to others even though they are in same segment. But before we begin, please note that this video is to share my knowledge, not to give any stock tip. Please understand the business before investing your money because the most important aspect of stock investment is conviction. And you get this conviction only when you understand the business and its growth prospect along with the key risk. Alright, let's get started. So first of all, the biggest factor behind valuing a company is earning growth. At the end of the day, what matters is how much company is growing in terms of earning. But this is not the only parameter. It's also important to gauge the sustainability of that earning. What I mean is, let's say there's a company that has generated excellent profit growth in last 2 to 3 years. But what is the guarantee that company would continue to generate high profit growth? Because today, when you are investing your money, you would be rewarded based on the future performance and not the past performance. Hence, sustainability of the earning growth is extremely important. Now, there's no magic wand that can predict the sustainability of earning growth. So at best, what you can do is try to identify the probability of high earning growth in the future. And for that, you need to look at various parameters. What are those parameters? So first is competitive advantage, or also known as moat. A company with strong competitive advantage has a higher probability of sustaining the growth. Second is growth prospect of the sector. Obviously, for the company to grow its earning, the sector itself should also have high growth potential, right? And we have already discussed that alcohol beverage sector in India has a bright growth prospect. So companies with strong moat and leadership would command a premium valuation in this category. And third, you need to consider the operating leverage and deleverage while analyzing the valuation of a stock. For instance, United Spirit used to command a PE of more than 200 during January 21. Now, simply looking at the PE ratio, would you have invested in the company? I'm sure the answer would be a big no. How can you buy a company at more than 200 PE? But that time, United Spirit share was at rupees 630, and from there now it is at more than 1500 levels, and PE has actually fallen to below 100. So basically your stock has more than doubled, but PE has fallen by more than 50%. How is that even possible? Because normally when the price goes up, PE also goes up. So that's because during 2021, companies' margin fell down badly due to lockdowns that directly impacted companies' operating profit as well as net profits. So it was operating deleverage. However, when economy opened up, margins zoomed and now margins are at 18% level. So operating leverage came into play that resulted in sharp jump in operating profit and multifold growth in net profits. Now this is a very important concept that I try to explain even in my weekly video series that include one exclusive video every week. Since I spend 8 to 10 hours a day in research, I share my insight regarding important government policies or key events that benefit a specific sector or theme and top stock within that sector or theme. I also share stock details where I am investing my own money and reason behind the stock selection. The idea is to share my knowledge and conviction, not to give any buy or sell call. Plus, this series is only for long-term investor. I also track more than 200 quarter results in an Excel sheet that really helps in identifying great investment opportunities. If you are interested, check out my website or join button of this YouTube channel. Now coming to the moat or competitive advantage, what is the moat in the alcohol beverage sector? So biggest moat is branding. Try to understand this. Brand building in alcohol beverage segment is extremely difficult. But once you build the brand, you get sustainable growth. Simply because consumer demand for that brand. And when consumer demands, even the retailers like to keep a good stock of that product and keep it on the top shelf in their stores. Plus, companies can charge a premium for that brand. So, higher margin. Now, if you look at companies like United Spirit, it owns some of the biggest brands in the spirit segment that include McDowell's, Johnny Walker, Royal Challenge, Signature, Black Dog, Smirnoff, Captain Morgan, Antiquity, and so on. United Spirit is an undisputed leader in Indian spirit market with around 25% market share. And remember that India is predominantly a spirit consumption market that is around 89% share. Beer is just 10% and wine is negligible as of today. And within spirit, whiskey has 63% market share. Clearly, United Spirit is a leader in the biggest alcohol beverage category of India. Then if you look at the financials, company's top line has been flat over the years. However, its net profits have grown significantly. One of the reasons is company's operating margins have expanded, and second, company's taxation has reduced. Company's 5-year profit growth is 16% CAGR and stock has compounded at 20% CAGR rate. Now, apart from growth, you should also look at profitability in terms of ROE and ROCE, which is also very good for United Spirit. Company is completely debt-free and it's generating more than 50% of cash flow against the EBITDA, which is again very good. Look at the cash company is generating every year from operations. So it's a highly profitable business and commands a strong leadership in the segment. But is it justified to pay a PE of 80 for United Spirit? So one way to look at valuation is by comparing with median PE of last 3 to 5 years. Historically, United Spirit has always commanded a premium. So you can't expect company to trade at a PE of 20-30. But today, the PE is slightly high, around 20-30% from median. Having said this, we are in a massive bull rally. So you can't expect top companies like United Spirit to trade at cheap valuation. I believe that United Spirit is a great SIP grade company to fetch consistent compounding over the years. Yes, a 15-20% correction would make the valuation quite attractive. But nevertheless, it's a SIP grade stock in large cap category with market cap of more than 1 lakh crore. Then another example is Radico Khaitan. Today it commands a PE of more than 100. Now does a PE of more than 100 justify? Well, first of all, Radico Khaitan has cracked the branding part of the alcohol beverage segment. Today it owns some of the top brands like 8PM, Rampur, Magic Moments, Royal Ranthambore, Jaisalmer Gin that commands a strong market in their respective niche. This has been reflected in company's top line that has grown from 1200 crore to 4300 crore in last 10-12 years. Company's net profits have zoomed from below 100 crore until 2017 to now at 270 crore. On top of this, management has guided for 14 to 16% margin by FY26 and currently the margins are 12%. So from current levels, there's a good scope for margin expansion. And once the margin expansion would take place, earning would increase at fast rate. So current PE is not considering this operating leverage. Having said this, Radico Khaitan commands a premium valuation because of this bull rally, but it's a great stock to consider in case of correction. Today, it's a mid-cap company with a market cap of around 28,500 crore. Then there's a recently listed company, Elite Blender, that owns brands like Officer Choice Whiskey and Sterling Reserve. Elite Blender is the third largest spirit company in India in terms of annual sales volume. But if you look at financials, top line growth has been flattish in last few years. Company has higher expenses that resulted in lower operating profits. And the biggest culprit here is high interest payment due to very high borrowing of more than 800 crore. Hence, company's debt to equity is 2. Now, due to high interest rate, high depreciation and high taxation, company ended up with negligible net profit. That is the reason its PE is showing exorbitantly high. Although price to sale is quite reasonable. In the recent IPO, company has raised a fresh issue of around 1000 crore, a part of which would be utilized to pay the debt. So with that, eventually company's interest payment would reduce, that would increase the profits. Having said this, it's a long-term play and for now it can be skipped. Then fourth player in the spirit segment is Tilak Nagar Industries. It has been a turnaround story where company was in massive loss for many years. But last few years have witnessed excellent growth in company's top line. Its borrowing got reduced big time and that resulted in exponential rise in bottom line. As a result, company's share price has already jumped exponentially in last few years. Here if you notice, company is paying zero tax in last few years because of losses in the past. So management has mentioned that they still have around 200 crore of tax credit available as of beginning of the year. So they don't have to pay tax for this year and tax payment will start from next year. So we need to see next year when companies start paying taxes, how it would impact the net profit and PE ratio of the company. Overall, if you look at the price to sell as well, United Spirit price to sell is 10, Radico Khaitan price to sell is around 6.6, Elite Blender price to sell is 2.9 and Tilak Nagar price to sell is 4.3. So from price to sale perspective, United Spirit commands a highest premium. But if you ask me to pick any company from these list, I would prefer United Spirit and Radico Khaitan in the spirit segment for long term. Just that both are trading at premium to their historical valuation due to this ongoing bull rally. But a 10-20% correction would give a good entry point. Otherwise, both are good SIP grade companies. Now moving on to the beer segment, United Breweries is an undisputed leader with brand Kingfisher that commands more than 50% market. But the problem is, it commands a P ratio of more than 120 years. In fact, in 5 years, median P is also more than 120. Company's top line and bottom line growth has been average, but since United Brewery has an undisputed leadership, market is paying a very high premium to it, which I find too high. And I'm not comfortable taking any position at such level. Then you have Som Distillery that is mainly engaged in manufacturing and sale of beer and commands a PE of just 25. The reason for low PE is because Som Distillery does not have any well-known premium brand in the category as of today. It's a small cap company with a market cap of around 2,500 crore. Although the company's top line has grown at a very good rate in the last few years, and even bottom line has grown at a very high rate. This growth is also reflected in the share price that zoomed multifold times from pre-COVID levels. However, in the last 1 year, share price has been consolidating. I believe that considering the growth of Som Distillery in the last few years and the potential in the near future, current P of 25 is looking reasonable. Interestingly, even the promoter of the company are increasing stake on a consistent basis over the last 12 quarters. Only downside is that there are no FI and DI holding and public holding is on higher side. But there are many HNI investors showing confidence in the company. In fact, Dolly Khanna, an ace investor, has increased stake in the company in the latest June quarter. Now next is Sula Vineyard that commands a market cap of around 4,000 crore and a PE of around 44. Now in spite of being a small cap company, Sula is a leader in Indian wine category. Although this category is very small as of today, but there is a growing premiumization trend where people like to enjoy premium food and wine. So I believe that Sula, being the leader in the segment, has a very bright growth potential. I've already done a detailed analysis on Sula. Financially, company's top line fell down during COVID, but then it has grown at a very good rate. Company's margins are also very high at 30% range. It has increased significantly over the last few years. As a result, company's net profit has also grown at a fast rate. Although in last 1 year, the net profit growth has slowed down. Its share price has also jumped from 300 levels to more than 650, but there has been a good correction in share price since the last few months. Even current valuations are at par with historical median. So I believe that this correction has created a good opportunity to consider Sula for the long term. Finally, let's look at companies where Elco Beverage constitute a part of the company revenue. So first company in the list is Global Spirit. Now I don't want to get into the detail of this company as I've already done 2 detailed videos on it where I've clearly explained its business model. Just to briefly explain, it has got 2 business segments. First is manufacturing segment where company produces extra neutral alcohol, that is ENA, as well as ethanol. This ENA is used as a raw material for alcohol production that is supplied to various companies. The problem is that it is a commoditized business where margins are dependent upon supply and demand as well as the government regulation around the raw material pricing. This segment contributes nearly 60% of company's business, and that is the reason Global's margins have been volatile in the past. It zoomed exponentially during COVID and then fell down badly. That directly impacted company's bottom line. As a result, company's share price fell down badly. However, recently the stock has doubled from the bottom, still below the all-time high level. The reason for sharp jump is because government has permitted the sale of up to 23 lakh ton of rice from Food Corporation of India's stock to grain-based ethanol distillery, and rice is a key raw material for Globus. Due to restricted supply in the past, rice prices went up significantly. That impacted Globus margin. However, now margin should see good recovery. So that's the first reason why Globus has outperformed recently. Second, Globus is focusing a lot on consumer business. But the catch is that out of around 40% consumer business, majority of company sales as of today comes from IL segment, which is a price sensitive market. Although Globus is continuously pushing for growth of IMFL segment and has already launched various products across category. In fact, recently it has launched its first single malt whiskey. Now today Globus P is showing 50, but that's because its margins are at an all-time low. Now that government has eased rice supply, margins should improve and P should fall. Having said this, company's median P is just around 16-17 for last few years because it was predominantly a manufacturing company. So in the future, company's P rating would be based upon the success of its IMFL business. If it can crack this business, it will see P re-rating like Radico Khaitan, but any failure to crack the business would see P de-rating. Globus today command a market cap around 4,000 crore, and of course, now that margins have bottomed out in manufacturing sector, it would be interesting to see margin expansion and its impact on its earning growth. Now next in the list is Piccadilly Agro that derives around 43% business from sugar segment and remaining from distillery products. One of its award-winning product, Indri, which is a single malt whiskey, has become very popular in the market. But I don't see valuation comfort at a P of more than 80 and price to sale of 10. Next company in the list is Associated Alcohol. It is similar to Globus Spirit, where it has manufacturing segment for ENA and ethanol, which is a low margin business. Then it has its own IMIL and IMFL products, and company also has contract manufacturing for United Spirit brand, as well as into licensing business with Inbrew and Diageo, which is the parent company of United Spirit. After latest government announcement on ethanol ban removal and rice supply ease, this stock has also rallied. Before that, it was also struggling just like Globus. In spite of that, its P is 32. While it looks lower in absolute terms, it is much higher than its historical average of 13-14. Company's top line is growing at a good rate. Margins were around 14-15% before COVID and now fallen to 10%. But management has already guided that its margins would improve because there's already a fall in raw material price. So going forward, I think once the margins would improve, your P ratio should fall. It's a micro cap company with a market cap of around 2,000 crore. My only concern is that there are no FIs and DIs in this company, and even there's just one HNI. One final name in the list is Triveni Engineering. It is among the top 3 manufacturers in India for sugar and second highest supplier for ethanol. As of today, around 75% revenue of the company is from sugar segment. Around 25% is from distillery segment, where it manufactures extra neutral alcohol along with IMIL and IMFL liquor. But company is yet to establish a successful brand in the category. Today it commands a PE ratio of 30. So today it is more of a sugar manufacturer that would benefit from government removal of ban on ethanol, and that is the reason its share price has recently jumped after the news. But you are yet to see how its business grows in consumer segment. So I hope you got a fair idea behind why some companies command a premium valuation as compared to others in this alco beverage market. The biggest reason behind premium valuation in stock like United Spirit, Radico Khaitan, United Brewery is competitive advantage due to successful brands that they have built. As compared to them, other companies have lower valuation, but that is mainly because they either haven't built successful brand in the category, or some of the companies are manufacturing business rather than consumer facing business. So you have an option. Either you pick the leader in the category like United Spirit or Radico Khaitan, but pay a premium, or opt for companies that can potentially do well in the future. In the short term, I think companies that are focused on ethanol and ETA that are more in manufacturing domain would benefit from recent lift off of ban on ethanol production and rice supply. But it would be interesting to see if these companies can sustain and make big brands in the future. Nevertheless, one thing is for sure, the future of alco beverage sector in India is very bright. Yes, valuation across the segment are stressed mainly due to this bull rally. So right approach would be to pick maybe 1 or 2 stock from the segment and invest systematically. A good 10-20% correction would make these companies look decent. Now tell me in the comment, which is your preferred stock in alco beverage segment? Also let me know if you want me to discuss any specific company from this space in detail. I'll see you next video. Till then, take care.